Hello everyone, welcome back to my YouTube channel. Today we are going to talk about Basel model number one. Then we are going to talk about probability of default in brief, and I'll tell you what are the important columns which are actually consider when you are making a probability of default model in either Python or any other language. But the columns which I'm going to tell you, they are going to be constant. Other than that, I would be talking about scorecard, that what is scorecard in banking, because I have worked on the scorecard, I have delivered the scorecard. So I'll tell you briefly what are the scorecards. So today's session is going to be super helpful for the people who want to search a job in the PD modeling space, and also they want to search the job in the scorecard models. So let's move forward without wasting your time. So guys, this notebook which is currently you can see on your screen, this belongs to the previous session where we spoke about the 2008 crisis, then banking regulations we spoke about, then we touched upon risk, credit risk and all. So if you want to go through all this and you want to understand all this also, so you can refer the previous video. Now what I'll do, I'll just create a new page here and I'll give the name, let's say PD. Let's create a new one. So here is the new notebook for me. Now let me quickly start discussing the concept. So the concept is going to be number one, what is Basel, and especially in Basel II, how the things are getting calculated. Now what is Basel? Basel is a model which is given to the bank to meet the regulatory expectations, so that bank should keep enough capital in their pocket that even if their portfolios are not performing well, so they should be able to pay the money of the normal retail customer like you and me. Okay. Now in Basel II, the PD, LGD and EAD had an approach to calculate. Okay. So there are two methods which I spoke in the previous session, that one is standardized approach to calculate all these three, and then there is a IRB approach. So standardized approach is something where you have to keep minimum 75% of capital, and moreover everything is driven by external. So let me create a table here. So you have standardized approach, then you have IRB approach. Now this IRB, this is internal rating base, is divided into two further category. One is FIRB, this is fundamental internal rating based approach which bank use. Then you have AIRB, that is advanced internal rating based approach. Now if using these approaches, if I calculate the PD, LGD, E and E, how this will be working. Now for standardized approach in the banking, PD is external. It will come externally in standardized approach. Even LGD will come from external sources. EAD also will come external sources. Now what is external source? These can be the company like FICO and S&P Global. So these are the company, they provide the ratings, okay, which we are using in standardized approach. Now in the IRB approach, in the fundamental IRB, PD is calculated internally in the bank by the programmer like you and me, and LGD and EAD are calculated externally. Again, we will use the data which is coming externally from, let's say, FICO or S&P. And in United States, I would say FICO is the gold standard. FICO is a score which is using, which all of the companies are using heavily. So FICO is heavily reliable. Now, this is the main thing. Okay. Let me explain one more thing which is very important. Now, what is in the IRB approach, AIRB especially. So for the AIRB approach, if you see all these three factors like probability of default, LGD and EAD, all these models are calculated internally. So internally bank have team and they would be working on all the calculations by themselves, and after this calculation they will calculate expected credit loss, which is represented with ECL, or sometimes we call it EL also, expected loss. Expected credit loss, expected loss, both are same thing, don't get confused. Now How this is calculated? This is the product of PD multiplied by LGD multiplied by EAD. Now, for the people who are coming to my channel for the first time and they have not seen the previous video, I'll just quickly explain what is PD. PD is probability of default, that how many chances are there probability wise that a person will default. Let's say I go to the bank to take a loan. So what are the chances that I will default? That is PD. Then LGD is loss given by the default. So at a particular time, whatever loss the loan is giving to us or a credit card is giving to us, that is considered as LGD. Now what is EAD? Exposure at default. At a particular time, what is the amount which is exposed to the loss? With time, this EAD decreases obviously, and LGD also decreases with time, because the people are paying EMI. So the more EMI they are paying, the less number of principal and interest they will hold, which they need to pay for the bank. So the more time they are paying nicely, the estimated loss is going to be less. Now, to calculate this, there are some approach. Let me go down. So for different companies, there are different approaches. So let's say when we talk about FICO company, which is a gold standard in US. So for FICO, the score range from 350 to 850, or some 300 to 850, something like that. 300 being the lowest score, 850 the highest. That means if a person, Rajat is there, if the FICO of Rajat is 850, that very less chances are that there that Rajat will default. And if Rajat score is 300, so there are more likelihood, more chances, and it's almost sure that this person will default on the basis of the previous history of this particular person. That's how FICO works. Now, one more company I mentioned to you, S&P Global. Now, the rating system in S&P is different. So this is the rating system. Pretty much easy in FICO, mathematical. Now, in S&P, the rating stands with A++++. So this kind of rating they have. It starts, basically, let me create a table itself actually. So A++ was an example of that. How they define the rating, that is bit different. So let's say AAA. It is the best rating if a person can get. Then there is a rating AA+, then AA, then AA minus. This is one group. So these are the most prime customer which are equivalent to this 850 score. Then this is a least, comparatively 850, this is a lesser score. Let's say 750. The people who are falling in 750 in FICO, they will come here. Then you have another bucket where you will have single A. So A plus, then A, and then A minus. This is less credit worthy people compared to this. These are the highest credit worthy people. Then you will have B, similar to A, triple B plus, then you will have B, 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 then you will have B, B, B minus. So these two are the type of rating, or moreover specifically credit ratings which company give. So let me show you. I think this table is not clearly visible to you. Let me show this table. If you see this, so that's how S&P Global gives you the rating. Okay. Now bank love the IRB approach, which I told you. Let me mention it. Banks love IRB, especially AIRB, so that they can lend more and more money to the market. Let me mention that, so that they can lend more money. Now many of you will think, why so? Because in standardized approach, you need to keep much more, like 75% of the money as a capital within the bank. So you cannot invest that in the share market. You cannot lend it to the other people so that they can make profit of it. But in the AIRB approach, you can get the exact amount of ECL, so that allow you to calculate the exact amount of capital you need to keep for your bank safety, so that there are no operations are interrupted. Okay, so this is about the approaches, different approaches, how we calculate PD, LGD, EAD, and in short, estimated credit loss. So this is about them. Now let's talk about one very important thing, that is asset classes and credit risk ratings approach. Now what are asset classes? Okay, so asset classes are, let's say you have what type of product you are having from bank. Let's say you are having a mortgage loan. Mortgage loan means you are having a house loan, which is, house is a mortgage, right? Then you have, let's say, credit card. So credit card is a different asset class, mortgage loan is a different asset class, then personal loan is a different asset class. Okay, now we calculate three things, as I told you: PD, LGD, and EAD. Mostly PD is calculated using logistic regression. Regression is pretty much common here. LGD is calculated using beta regression. EAD also calculated using beta. What is logistic regression? What is beta? Forget it for now. Just remember PD is calculated using the logistic regression, EAD beta regression, and LGD also beta regression. That is pretty much clear. Now next important point, when you are calculating the PD, as I told in the starting of the video, when I am calculating the PD, so what are the important variables which I need to consider? That is very important. Let me mention that. Let's mention that now specifically. So PD, if you calculate it individually, as I told you, it's probability of default. So what are the likelihood that the person will default? Let's say in the previous scenario, let's say in 2024, there is a bank, and bank have noticed that in the mortgage portfolio, like the people who are taking home loans, so one person out of 4 is defaulting. That is a sequence. Now, so the PD value will be 25%, because 25% of the people are defaulting. So that's how PD is getting calculated. Now to calculate the PD, what are the important things need to be considered? And in the previous video I mentioned, so there are some factors. So two type of factors are here. One is borrower based. Who is borrower? Like you and me, the people who are taking the loan, they are the borrower. Borrower based factor. Then economical factor. What is economical factor? Let's say suddenly there is a GDP is down of the country, there is a inflation, some war happened, let's say Ukraine war happened, so the GDP of Ukraine suddenly fall, or some news came about the country, so obviously that affect the GDP of the country. And then what type of city you are staying in, those things matters a lot. Now on the basis of these two factors, what are the columns which are needed for building a PD model? So I'll tell you the column names now. Columns. So the name of the column starts from demography. Like which place the customer belong to, whether that person belongs to United States or whether that person belongs to Afghanistan. I think this clarifies what I am trying to say. So a country where there is so much stability and the dollar price is amazingly going up. There is a country, Afghanistan, where there is so much uncertainty. Okay. So the reason is because stability of the country, demography depends a lot, like whether the person will be able to pay the amount or not, because that is very important. So demographics is one, as I mentioned. Then the age of the person also play a big role. What is the age of the person? Because a older person, maybe there is chances, like on the basis of age, let's say a person is almost 57 years of age, that person will retire soon, and there is a chance that that person may not be able to earn money and pay back the money. while there is a person whose age is 33, so there is so much job left for this person, so there is a chance that this person will have less likelihood to default. That's why it's a very important factor. Then the address, this is important, like which city that person stays in, like because every city have a different income bands, type of resources available, everything matters. Now the marital status, whether that person is married or not. Obviously if the spouse would be working, there are high chance that that person will pay back the amount. Then the education background, education also matter, because if the education of the person is from a very good institute like MIT in US or IITs in India, so obviously that person will have higher salary compared to the other people, so this person will be able to pay the amount. Then what is the income? Directly, income is clearly the most important part of a model, because how much that person is earning, that is always equivalent to that person will be able to pay the money or not. Similarly, these are the variables which bank usually hold. These are the variable which the bank will be having. Let's say I work for JP Morgan, so JP Morgan will keep these variables with themselves. Now JP Morgan will take some external variable also from, they will ask, let's say Equifax, a data provider in US, so they will ask Equifax that send us the credit worthiness of this customer. Now let's say Equifax is one example I'm taking, or you can mention third party. So they will give you some more examples, some more columns. So that's why I made this plus symbol. These are the variables. Then there is a variable called credit rating of the customer. This is an external variable. Again, there is a variables like inquiry, like in previous month or previous years, how many times this person has applied for loan, how many times this person got rejected. So all those columns are very important when you are calculating a PD model. Now when you build a PD model, so from the teams whom you are working with, so you are what? You are a model developer. Now to you, who is giving the instruction? Model owners. Mostly they are on the onshore. Who are the model owner? Model owner are the people who are actually working on the bank side, and they are like any particular product owner like credit card or loan or anything like that. So they are known as model owner. What are the input they will give you? They will give you the model details in this format. Let's say 3 type of variable. They will give you the column name, or they will sit with you and assess what are the columns you need to use. Then the values, what are the values of these columns. Then they will give you coefficients. Values will be what? Like for example, column age. So there is a bracket will be there for age. Let's say 25 to 35. Then 35 to 45. Then let's say 45 to 55. What is coefficient? The multiplier which you will use in the code to calculate the PD. This is a table for the PD calculation. Now coefficient can be 0.32, for this 0.36, for this 0.72. So this is one example of one column. Like this you will have so many columns in your table. On the basis of that you will write your either Python code or you will write SAS code. That is totally depending on the bank you are working for. So that's how you calculate the PD model. So on that note, I'll stop myself for the day, and in the upcoming video maybe I'll give you a brief background of what are the scorecards, how the scorecard model actually works. So I think let's wrap up today's video here, and I hope if you find this video helpful for yourself, so please hit the like button and please share this video with your friends and your family. Whoever want to learn all this, this is a knowledge which you will not usually get on any of the websites. Okay. Also, I will attach this sheet link in the description box, and I'll put this in the GitHub, so you guys will be able to download it from there. It will really helpful. Okay guys, so I'll see you in the next video. All the best. Thank you so much.